Soon to be a corporation, TSX-listed Carfinco Income Fund is led by President and CEO Tracy Graf. He presented at our 2009 conference. Some in today's audience were there. The units were approximately $1.80 a unit. It's converting to a corporation, so we'll be talking stock later on. But at $1.80 a unit, a $10,000 investment would have returned you, as of this conference, more than 400% net. In context of 53% of your original investment back in cash, plus there have been special unit distributions and the appreciation on your original position. And you can see it's come a long ways from $1.80. It's currently sitting in the $6.20, $6.30 range. In the time that we've been working with Carfinco, which has been the past few years, the management team has never missed a projection, met or surpassed every objective, and has a succession of record earnings quarters. The insiders have written large checks over the years and hold about 40% of the stock, and they've bought it on the same terms and conditions as everybody else. The greatest amount of options this company has ever issued was $100,000 to the CFO. So is the story over? 3 analysts have price targets of $9 to $9.50, and recently the monthly distribution, or soon-to-be dividend, was raised to 3 cents. So that's 3 cents per month. Christmas is coming, and I wonder what special treats Tracy and team are going to put under our trees, because they tend to like to surprise people at the end of the year. And with that, I'm going to give you the very understated Tracy Graf. See, you're hiding in the back of the room. Tracy? Thank you.
Thanks, Grant. Good afternoon, ladies and gentlemen. I'll try and get through this presentation in the 15 minutes without hopefully missing anything too important. I enjoy talking about Carfinco. Just a quick background. The company was started in 1997, so we've been around for quite a while. And in Q2 of this year, we had revenues of $14.4 million, pre-tax earnings of $5.8 million, net earnings of $4.3 million, and so our earnings per unit were 17 cents, and this was for Q2 of this year. Q3 is obviously ended now, and we anticipate releasing our results for Q3 in the first week of November. As Grant mentioned, we are going to be converting to a corp. Ironically, Halloween's coming, and it was Halloween, I believe, 2006, when the government brought out the changes in the tax laws for income funds, which were effective January 1st, 2011. So we have announced that we are going to convert back to a corp January 1st of 2012, subject to shareholder approval. As Grant mentioned, there are 3 analysts that are currently following Carfinco, and this is what they're saying. Their forecasted revenue, Q2's revenues annualized, were $57.6 million. And right now we're on a growth target, and we've stated this, that we want to grow our portfolio, our finance receivables, by 20% per year. I've been asked this a lot in the recent past. If we go into another economic downturn, what's different now than in 2007, when we seen the first economic downturn, and in 2008 we actually halted distributions to conserve capital within the company. There's a significant amount that's changed since then, and I believe that even if we were to go into another economic downturn, which I don't believe would be as severe as the last one, if we did, I believe that we're in a position now where we would be able to maintain our current 3 cents a month distributions. And one of the reasons I say that is, in 2008, we had to add a non-cash expense of $5.7 million that hit our income statement, and that was our reserve for future losses. We had to increase it by $5.7 million. At this current time, we are over-reserved by more than that with our bank covenants. So we're over-reserved by more than what we had to put in 2008. Also, we had swap agreements. We had $20 million of our debt locked in on swap agreements, which was a non-cash expense that hit our income statement in 2008, and it was $1.5 million. Since then, one of our swaps has expired, so we only have a $10 million swap right now that expires next September, and quite honestly, it can't get any worse than what it is right now. Our fair market value is at the full extent, so it can only get better, not worse. So that would not hit our income statement like it did in 2008 either. So those two things, along with record loan originations under our underwriting that we strengthened in 2008. We're currently in Q2. We had loan originations of $28 million. As Grant mentioned, in the automotive finance industry, that's all we do is non-prime auto finance, as you'll see in the presentation. The used car dollar is strong. It didn't weaken like it did before. The U.S. wholesalers never have came back into the marketplace. When they left, used car prices plummeted. There was more supply than demand. That's not the case this time. The Canadian dollar strengthened right about the time that in 2008 when our first economic downturn occurred, and that's why the U.S. wholesalers quit coming. The price of gas went up substantially in 2007, 2008, which was quite a sticker shock to all of us. We're used to it now. It hasn't changed substantially from what it was back then. So our customers have budgeted for paying what they are for fuel at this time. So some of the key investment highlights are, as Grant mentioned, our growth rate. We are growing by 20% per annum. We have done for a number of years now, and we've had 9 consecutive quarters of record pre-tax earnings the last 9 quarters. Our management team has been myself, our Chief Operating Officer, and our Vice President of Business Development and Operations were founders of the company. We've been with Carfinco since 1997, and our VPs of Account Management have both been with the company for over 10 years each. So we have a wealth of experience within this industry. There are a number of barriers to entry in our business, and in terms of knowing how to properly price our product and properly collect it. It's easy to put money out. The trick is getting it back. And what we also do is everything internally. The only thing we third party out is the actual repossession of a vehicle if it's required. We have bailiffs in each of the provinces that do the actual physical repossessions of the vehicle. We've invested a lot in technology, which has substantially increased the efficiency of Carfinco. One of them being a GPS starter interrupt unit that's mandatory to put on almost every vehicle we finance. And what this is when we know that a payment was missed, which we find out about within 2 business days, we enable a warning device on the vehicle via the internet. So every time the customer turns their car on and off, a buzzer goes off for 20 seconds inside their vehicle, which is notifying them that they have to contact us. If they don't contact us within 5 business days, via the internet, we disable their vehicle. They can't use it. So they basically, if you want to use your vehicle, you have to make your payment. This shows our current credit facility. We've been with Bank of America since August of 2000. At that time, we had a credit facility of $7.5 million. And as you can see, since then, have increased it to $130 million and have added Wells Fargo and Bank of Montreal through their Harris Bank branch in Chicago to the syndicate. We're geographically diverse. We do operations in every province in Canada, with roughly half of it Manitoba West and half of it Ontario East. This just shows a quick overview of the Canadian used car market. The note of interest is at the bottom, where 81.5% of vehicles are 4 years old or older on Canadian roads. That's right in the wheelhouse of where we finance. The average age of vehicles at the time we finance them is 4.5 years old. Most of our business is done on the used vehicle side of the business. We do deal with franchise dealerships and independent dealerships in the used car sector. This shows the competitive landscape in Canada in terms of our competitors that also do financing in the non-prime auto finance market. As you can see, during the last economic downturn, HSBC, Wells Fargo, and Americredit all exited the Canadian marketplace. And in fact, we've been secured to service and wind down the Wells Fargo portfolio for the U.S. entity that acquired that portfolio. So those three are no longer originating new loans, and we're winding down the Wells Fargo portfolio. TD through the acquisition of a company called VFC, and Scotia through the acquisition of a company called Travelers are the two largest lenders within our marketplace, being non-prime. However, really do not compete with us because they focus more on the near-prime business, prime and near-prime, where we focus on a D customer is where our market space is, and I'll get to that in a sec. So the boxes show roughly where we are in terms of our competition. RIFCO is another Alberta-based lender that has a smaller portfolio, and we really don't compete with them at all as well. As you can see, right now we anticipate that about 90% of our portfolio we do not compete with the other three lenders, and 10% we do compete with the other lenders. And this shows every Canadian is tagged with a 3-digit credit score. Every North American, actually, with the Beacon score. And you can see the A and A+, 680 and higher. Those are Canadians that have no issues obtaining credit if and when they need credit. And that's about 65% of Canadians. And you can see the D and the no score equate to about 24%. No score is they either haven't established credit yet, or they've just moved to the country and don't have any credit, or they've damaged their credit history. That's the market that we focus on. As you can see, it represents 24% of Canadians, but it represents the majority of our portfolio, which is the green. It represents 94% of our portfolio, and only 6% is where we're currently competing with the other lenders. It's just an average everyday Canadian that we finance, and this is our typical car loan, an average of $12,000, an average payment of $406. As I mentioned, the vehicle age is 4.5 years old, and our interest rate is 29.5%. Our effective rate with the administration fee is 32.9%. That's been the interest rate for, when we got in business in 1997, 29.9% was the consumer interest rate. A Canadian Tire credit card is 29.9% interest rate. The Bay MasterCard, if you carry a balance, is over 29%. So that is the accepted consumer rate. The usury rate in Canada is 59.9%, which we're well below that, with, as you can see by our effective rate. Now, this just shows our growth over the last number of years. At Q2 2011, we had a $152.5 million portfolio, as well as servicing that Wells portfolio, which is roughly the same size. Our revenues were $57.5 million on an annualized basis. Our earnings, Q1 and Q2 2011 are after-tax earnings. Prior to that, we weren't taxed as an income fund. So those are Q4 previous are pre-tax numbers. As well, Q1 and 2 2011 are under the new IFRS accounting standards. which didn't affect us a whole lot, other than if you were to look at our finance receivables prior to and post IFRS, the numbers are different to a certain degree with our how we have to account for our finance receivables. This shows our return on equity. The first half of 2011 annualized, we've achieved a 56.3% return on equity. And as you can see, pre-tax in 2010, we were 79.4. As I mentioned, 2008, we lost, we were negative earnings because of those two non-cash entries. Without those non-cash entries, we were over $5 million to positive income. This just shows our loan origination and portfolio growth. In March of 2011 was our record month, and we had announced over $10 million in loan originations for that month. We have surpassed that target in months since March of this year. This just shows our capital structure, just under 25 million units outstanding, soon to be shares, and shows the insider and free trading. There are no warrants, as Grant mentioned, and just 100,000 options were a one-time grant to our at the time, our CFO, who is now our COO. Troy Graf is my cousin, the Chief Operating Officer. Stephen Dykow is our CFO. Prior to joining Carfinco, he was with our auditing firm, Grant Thornton. And the Board of Trustees, David Rosenkrantz is the chairman of the board. And we've had all of our Board of Trustees bring a significant amount of wealth to the board. So why Carfinco? We have proven that we can maintain a 20% per year growth in our finance receivables, even with the uncertainty in the markets right now. We intend to maintain the 3 cents even as a distribution after we convert to a corp on January 1st, 2011. We've had 9 consecutive quarters of record pre-tax earnings, and the management and the board have as much vested in this, in making this a success, as the unit holders. And that's the quick story on Carfinco. Thank you.